Morning, everybody. Here's another video. We haven't had one for a while, depicting how common shares are transacted and accounted for in a corporate environment. So in our first example, we got this guy, Houston Company, is authorized to issue an unlimited number of no par value common shares. Now, the word no par value means that they don't have a par value slash stated value. No, I kind of go back and forth between those terms. That they mean the same thing, par stated value. So if I start talking about that and you say to yourself, wait a second, is this a par value share or a stated value share? It really means the same thing. But in this case, there is none. Okay, there's zero. It's not stated at all. So basically, whenever they sell it, that's basically the value that they get for it. So in the first example, they've issued 5,000 shares at $5 a piece. Okay, well, this is pretty straightforward. We're gonna debit the bank because this is a form of equity financing, as assuming you've already mastered that concept by now, meaning that they just sell shares and they get money for it. Okay, and they sell common shares. Okay, which is going to be an account sitting in our equity amounts. Okay, and to issue common shares. Okay, very, very straightforward stuff. Not too hard. Now, in the next case, instead of getting cash, they're going to pay for a building repair. Okay, so there's a $3,000 building repair, and then maybe they just don't have the money lying around, or maybe the contractor requested it, what have you, and the contractor would like to be paid in shares of the business by Houston Company. So we're going to debit building repair expense, and then we're going to credit common shares again, okay, because that's what we're giving away, and that's going to be for $3,000. Okay, now in case you haven't figured it out, the 3,000 comes straight from here, the value of the building repair itself, and to pay for, whoops, that's all I'm going to change now, repair with common stock. Let me see if I can't change that back to the thin one. There we go. Okay. Now, the last one is a similar idea. We've bought some equipment, and for whatever reason, they've decided to pay for it with common shares. Okay, what we use in this case is the fair market value of the equipment as the value of both the equipment, of course, and of the shares that we've distributed out. And that's pretty simple, to pay for equipment with common shares. Okay, now remember again that a common share is a piece of ownership of the business. All right, it's a small, tiny component of it. It doesn't mean you have a whole lot if you have just one common share, a whole lot of ownership of the company's assets, but it is a tiny piece of it. And in some cases, it's actually pretty valuable to own some common shares within a business, which may be why the people who sold them the equipment wanted some common shares. Who knows? All right, now moving on to the second half of it. Let me move this out here so I can get to the second page. And we're going to do a couple more. This time, though, ours are going to have a $4 stated value or par value. Like I said, it's interchangeable. Okay, so in example A, Evans Limited issued 2,000 shares at stated value. Well, that's actually pretty straightforward. Bank, again, we're dealing with just common shares. There is the preferred shares, but that will come up in the next example. Okay, common shares, we just take the 2,000, multiply it by 4, and that gives us $8,000. So again, you take your 2,000 shares and you multiply that by the $4 par or stated value, what have you. I called it stated value up there. And that gives you the 8,000. Okay, that's where the number comes from. Okay, and to issue 2,000 shares. Okay, that's it. Now, here's where it gets, I don't want to say it's tricky, but a little more convoluted. Okay, we're going to again have a debit to the bank. And what we've done is we've sold 3,000 shares at $8 a share. So that means there's a $24,000 debit, pardon me, to the bank. We're going to go to common shares as a credit. But you have to realize that in this case, the stated value of the shares is only $4. Okay, so we've sold 3,000 of them. That means that we've only sold $12,000 worth of common shares. Seeing that quite clearly that the question does not balance, that means that we have to put it to an account called contributed capital in excess of par or stated value. And I'm going to put stated value. Okay, and that gives us our other $12,000. Now this account here is an account that will show up within the equity section of the balance sheet. We're going to deal with that in a couple of activities, but for right now, just realize that if you have stated value shares, which we do here, that have a stated value, and we sell them for more than the stated value, the excess amount has to go to contributed capital in excess of stated value, which is actually, once you read it and understand it, it's sort of self-obvious that that's where the money would go, obviously. But that's where we're going to put that 12,000 bucks, okay? And I will say to issue 3,000, and I'm just going to mention $4 stated value shares. Okay. Just to move on just a little bit now that we've got that idea down that there's a contributed capital in excess of stated value, we're going to reacquire some shares at stated value. Again, the stated value is $4 a share. So quick math, 1,500 times 4 equals $6,000. All right, and look, what we're going to do essentially is just reverse an early entry. When we sell them, you debit bank and you credit common shares. This time, you're just going to do the exact opposite. You're bringing the common shares as a decrease. You're reducing them, so you debit that account, and because you're buying them back, you're going to go to your bank account and pay for them. So you credit the bank account for 6,000 bucks, and to reacquire common shares. Okay. All right. Now, lastly, this is sort of like what we experienced in the first question, where they pay for these a piece of equipment in this case with shares. Okay, and it's worth $10,000. Now let's do a little math over here. You realize here that they sold 2,000 shares at the stated value. Well, remember the stated value is $4. Okay, and again, just in case you're wondering where that comes from, straight up here up at the top. I'll always give you that figure, so don't worry about that. All right, so that's only going to give us $8,000. So we're going to complete common shares is going to be a credit for $8,000. Okay, now on top of that, just as we did before, we have contributed capital in excess. So we have to write this great big long account name, contributed capital in excess of stated value. All right, and that's going to be kind of like our plug figure, okay? 2,000 bucks, since we know that the equipment's worth 10, the common shares we gave up were worth 8, the contributed capital in excess of stated value has to be worth $2,000. And to issue 2,000 $4 stated value shares for equipment. That got really messy at the bottom. Well, let me rewrite that. Okay. Okay, slightly better. So there you go. Those are the transactions that have to do with the common shares. If you want to, I forgot to mention at the beginning, as usual, there's a worksheet. You can print it off. You can rewatch the video. You can walk through it step by step. If you get any questions, let me know. I think this stuff is pretty straightforward, but hey, if you need a little bit of help, Doesn't hurt to ask. Okay, thanks, guys.